Great. Welcome you all to the third edition of the Consolidation. Great. Today we look at the intra-group adjustments and then we are done. Right after the intra-group adjustments, we pick a focus thing to do justice to it. This intra-group adjustment will be applicable to both consolidated statement of financial position and the consolidated statement of profit or loss or the comprehensive income. So that is it. I'm doing all the intra-group adjustment together. So when I'm done with the intra-group adjustment, you are done for both consolidated profit and loss and what the financial position. Good. So now let's see the game. Let's see the game. So intra group adjustment. Intra group adjustment. Okay. So we'll look at this. There's several sections. Good. So first, we look at number one on the list is intra-group sales. Intra-group sales, which will give rise to unrealized profits. So it will give rise to what? Unrealized profits. Intra-group sales or transfers. Transfers. So that is the 1A. Let's make it A. It will give rise to what we call unrealized profits. Unrealized profits. Good. Then we look at the number two. In number two is the intra-group debt. So intra-group debt. Intra-group debt. Three. That is the current asset and current liability. So intra-group debtors and the creditors. So let's make intra-group receivable and then payable. I like receivable more than debtors. So let's see. Intra-group receivable and payable, which will also amount to A. B, it will amount to what we call cash or goods in transit. Cash or goods in transit. In transit. Good. And the third one is the intra-group loan. Intra-group loan. Intra-group loan. Intra-group loan. That's all. Intra-group loan. And let's go to the fourth one. Intra-group dividend. Intra-group dividend. Intra-group dividend. Good. This one is between parent and its members. So parent and subsidiary. When you say intra, between the parent and what? Subsidiary. Transactions between parent and then subsidiary. However, we will look at transaction between investor and the investee. That is the investor and who? The associate. Investee is the associate. That one, we are not going to call it intra-group. Why? Because there's no control. So we will look at this first. When we are done, look at associates. So this is between parent and then the subsidiary. Parent and the sub. So we look at investor and the associate later. So I'll go through step by step. As soon as I'm done with this, now you can pick any question together with what we did last week, and that's all for consolidation. That's all for consolidation. Good. So the footnote that we are going to give it to you comprised of this together with what we did last week. Great. So that is it. Now let's start with the intra-group sales. Now there's one thing about consolidation. In consolidation, the parent and the subsidiary, they are one because we said that you are going to prepare the account as if they are what? Single economic entity. In consolidation, we prepare the account as if parent and subsidiary are what? They are one. If you are one, can you sell to yourself? Not at all. Can you buy from yourself? Not at all. So you can't sell to yourself. So what do? So intra-group sales must be eliminated. So let's see. Oh, so we are on intra-group sales. Now, it will be intra-group sales or transfer. That will be the purchases. So how do you treat intra-group sales or intra-group purchases? Because one person will sell and one person will buy. So that is it. One, accounting treatment. Number one, the entire sales must be eliminated. The sales must be what? Eliminated from both the seller and the buyer's book because you can sell to yourself. Good. So first, subtract it from sales. That's if you are doing consolidation for P&L, profit and loss, that's the treatment number one. Treatment number two, subtract it from where? Cost of sales, because it will be part of the buyer's cost of sales. But please, here, it's an issue. I'll explain. So when you are doing a consolidation, the sales figure must go down by that amount, and then the cost of sales must also be subtracted, irrespective of who made the sale. Yes, whether the seller is the parent or the subsidiary. So during the post-acquisition period, parent sold goods to subsidiary amounting to 50,000 cedis. So when you're doing your consolidation, the entire sales must go down by 50, the entire cost of sales must go down by 50. It ends there. Good. Please, what type of sales are you going to eliminate? Here, let us be a bit careful. Here we have to eliminate what we call post-acquisition sales. Please, it is post-acquisition intra-group we are dealing with. Post-acquisition what? Sales. Let's assume that parent acquired a subsidiary on 31st March 2018. We are going the financial statement as at 31st December 2018. This is a reporting period. This is a consolidation period. Now the issue is this. I will tell you that the subsidiary has been a regular customer of the parent, and throughout the year he purchased 1,000 Ghana cedis from the parent. 1,000 Ghana cedis per month throughout the year. So 1,000 Ghana cedis per month. Please, in elimination, you have to only eliminate the post-acquisition period. Post-acquisition means right after acquisition. Any sales between them must be set off or must be subtracted. But the before acquisition, do not eliminate that one because that one they are not one. They were operating differently. Let me repeat again. We only eliminate post-acquisition sales. Post-acquisition. That means after acquisition. So if the parent acquired a subsidiary here, sales from January up to March must not be eliminated. That one must be there. Eliminate from March up to where? That is December. And then I said that the subsidiary has been a regular customer of the parent. So every month they trade among themselves at the value of 1,000 Ghana cedis. So when I'm doing the elimination, I'll tell the examiner that from 31st March up to 31st December, how many months? 9 months, right? Good. From 31st, it will be 1st April up to 31st December 2018. So that will be 9 months. So I will have to eliminate only 9 months. The first 3 months, that one is pre-acquisition. So we only eliminate what? Post-acquisition. So let me write it here. Post-acquisition. We only eliminate post-acquisition. Pre-acquisition must be there. Do not touch it. We are done. On the day that they acquired the subsidiary. Pre-acquisition. Pre-acquisition. So on the same day, which one came first? Sale came first before the acquisition. Acquisition came from immediately after acquisition. It's post-acquisition. So let's assume that on the same day, 31st March, there was a sale. Check the time. When was the sales placed and then the acquisition? Which one came first? If the acquisition came first, then it become post-acquisition. The sales become post-acquisition. So now you have to eliminate. In short, eliminate sales after the acquisition period, not before acquisition. Sales what? After acquisition period, not what? Before. Because before the acquisition, you guys don't know each other. So you guys were trading as like normal customers. But until you acquire like Airtel Tigo, the operators were competitors, right? Good. Like taking EcoBank and then the Trust Bank, for instance. So until the acquisition, they were just customers or competitors. So that is it. Now, anytime there is intra-group sales and there was leftover, it will create what we call unrealized profit. Please, let me repeat. The intra-group sales affect only profit and loss. If you are doing console P&L, it does not affect console balance sheet or console financial position because there's no way I can subtract the sales. Good. So we should take note. Now, let's move on to the next item, the B. Number 1B, we said that normally creates what you call unrealized profit. So anytime there's post-acquisition sales and the leftover or some of the goods left in inventory for unrealized profit. So let's see. Let's see this. 1B. We are looking at 1B now. Unrealized profits. 1B. Unrealized profits. Unrealized profits. So there are 3 ways to get unrealized profits. We look at only 2. The first one is PUP on goods left in inventory. Now let's see. Unrealized profit simple means one of the members, either the parent or the subsidiary, have made a profit from the group, but that profit is still within the group. So some, either the parent, so parent will sell something to us, recording a profit of 30,000 Ghana cedis. If parent, if the subsidiary have not been able to sell these goods out, oh, that profit that the parent said has made on that sale is still within the group, which must be eliminated. And that's what we call provision for what? Unrealized profit. There'll be some profit earned by either party, either parent or subsidiary, but that profit is still sitting within the group, which must be what? Eliminated. Because that profit has not been what? Passed on. And then how do you get it? There are three solid ways that you should know only two. Yes. First is PUP on inventory, goods left in inventory. So unrealized profits on goods left in inventory. So on inventory. Then two, unrealized profit on transfer of non-current assets. So let me call it unrealized profit on what? Sale of non-current assets. Sale of what? Non-current assets. Finally, we have unrealized profit on transfer. So transfer, but that one don't worry yourself much. Transfer. You can transfer, for example, non-current assets to inventory and vice versa, or inventory to non-current assets. Maybe the parent company is in the automobile industry. He assembles vehicles and then sells them. So vehicles are inventory of the parent company. Then the subsidiary needs certain vehicles for the administrative work. Good. And then the subsidiary will go and then acquire those vehicles. So now it's what? Inventory to what? Non-current assets and vice versa. It can also be from non-current asset to what? Inventory. Good. So that is it. Fine. Or we will look at these two. Yes. That's the most critical ones. And then we are done. So let's start. Unrealized profit on inventory. Good. Unrealized profit on inventory. Please, the truth of the matter is that you don't need to sell to yourself and make profits. Yes, because if you are selling to yourself, you can't sell to yourself. That's the first point. You cannot sell to yourself. So if you sell to yourself and you make some profit, and that profit is still within the group, it must be eliminated. So let's start with this one first. PUP, unrealized profit on inventory, goods in inventory. Goods in inventory. So let's see. Here, let's assume that parents has dispatched goods worth 50,000 Ghana cedis to the subsidiary. The question is, at the end of the reporting period, do you still have these goods in inventory, which will form part of the subsidiary's inventory? If yes, then definitely the profit recorded by parents has not been what? Passed on fully. So let's assume that the parent make a total profit of 50,000 cedis and they made a profit of just 10,000. Profit of 10,000 and the sale is 50,000. And then let's assume that the subsidiary have not disposed any of these goods. All the goods are still in inventory. Extremely, all the goods are what? Still in inventory. So the question is this: when the parent made a sale, parents were shouting, "Wow, I've made a profit 10,000. Wow, I've made a profit 10,000." Subsidiary took these goods, hoping that subsidiary will sell these goods to the outsiders, to the third party. But at the end of the reporting period, subsidiary have sold nothing from these goods. All the goods are still in what? Inventory. So that 10,000 the parent claimed that he has earned it is still within the group. So he has earned it from the subsidiary's pocket, which is supposed not to be so. Because it's like robbing Peter to pay Paul, right? You've earned it, but it's still within the group. It's coming from the subsidiary parent, so subsidiary pocket. So, so, so easy. Forgive me. Let's know. So, the parents have made that profit from where? The subsidiary's pockets. We're supposed not to be like that. So you have to eliminate it. That's all. So how do you do the elimination? So it means that you have to find the profit, the goods left in inventory. Is the goods left in inventory times the profit holding. Then we look at the accounting treatment. So all what you have to do is first calculate the PUP itself and do the accounting treatment. So first calculate the PUP, that's the unrealized profit. So first thing you have to do is calculate the unrealized profit. Calculate the unrealized profit. That's the first thing you have to do. Unrealized profit. B, and do the accounting treatment. The unrealized profit is equal to goods left in inventory, goods left. If the subsidiary has been able to pass on all the 50,000 goods, there's no PUP because the goods are not in inventory. So goods left in inventory times the profit holding, usually markup or margin. This is where your examiner will be moving you through markup and margin. You have to be aware of markup and margin. This is a section where the examiner will be moving you through markup and then margin. So kindly familiar yourself with markup and margin. That's all. So times the profit loading. That's all. So if you want to calculate the unrealized profit, just pick the goods left in inventory times the profit loading. Good. Then B, accounting treatment. The accounting treatment. B is what? The accounting treatment. So after calculating the unrealized profit, treat it. Accounting treatment. Here the accounting treatment depends on who made the sale. Who made what? The sale. Good. So before you do the accounting treatment, ask yourself, who was the seller? Is it parent or the subsidiary? So here, treatment number 1, subtract it from the seller's profits. Subtract it from where? The seller's profit. Subtract it from the seller's profit. That's the treatment number 1. Subtract from where? Seller's profit. So the one who made the sale. So let's give an example. If it is a parent who made the sale, what is parent's profit? It's in group retained earnings. Go there and go and subtract. You are done. So e.g., example, if it is a parent, subtract from where? Group retained earnings. Good. If it is a subsidiary who made that sale, don't worry. Subtract it from where? Net asset at reporting. At what? Reporting. Subtract from the net assets at reporting. Net assets at reporting. Net assets at reporting. Good. That's the first leg. First leg, after you have calculated the unrealized profit, ask yourself who made that sale. Take it off from the seller's profit. If the parent is the seller, go to group retained earnings, go and subtract it there. That's workings number 5 or so, right? Group retained earnings, workings number 5. Go there, go and take it off. What if the subsidiary is the seller? Go to subsidiary's profit. Where is it? Net asset. Subsidiary's profit is the net asset. Workings number what? 3. go there, put it at reporting. At acquisition, put dash there. It will go to at reporting. You put the figure there, subtract, you are done. Second leg number 2. Definitely, the goods will be part of the closing inventory figure, right? So go there and subtract it. So second, I'm continuing from here. Treatment number 1, treatment number 2. Subtract it from the group inventory. Subtract from where? Group inventory. Subtract from the group inventory. So on the statement of the financial position, subtract it from where? The group inventory. Now this is the balance sheet section. What about the profit and loss? Because I'm doing all together. Assuming you're doing profit and loss, there's no balance sheet. Okay, profit and loss. Where's parent profit? Where's net asset? No. For the profit and loss, just add the unrealized profit to the cost of sales. It ends there. So what we've done here is for the balance sheet. So treatment number 3, only to the P&L. So in a P&L, add it to what? Add it to cost of sales. Cost of sales. That's all. You are done. So in a P&L, add it to cost of sales. In the P&L, add it to cost of sales. In the P&L, add it to cost of sales in the P&L. That's all. So now I'll give you 3 different ways to arrive at the unrealized profit. Here we know that the treatment is so straightforward and so simple. It is a calculation that we are going to use it to worry you. So kindly be with us when we are going through the calculation. Okay, so now let's see. So first, calculate the unrealized profit, which is the goods left in inventory, times the profit loading. So I'll cite some few examples here. Then we go to the critical ones. Critical. Okay. I'll not clean this one. I'll only clean the top and do the illustration at the top. Or can we start from here? There's some space here. Okay. Now, let's assume that parent sold to subsidiary. So when you see me doing this, that means parent sold to subsidiary. Yes, that's mine. Parent sold to subsidiary at total value of 40,000. Total value of 40,000. Earning a profit of 25% margin. And you know here you are going to use markup and margin. Margin means it's on sales, right? Good. So here, then we come back again. We'll tell you that at the end of the reporting period, 1/4 of these goods has been sold or passed away by the subsidiary. So 1/4. So that's 25% of these goods has been passed away. So 1/4 of the goods has been sold. Has been sold. 1/4 has been sold. Of the goods has been sold. Good. So if 1/4 has been passed away by the subsidiary, then left with how much? So 3/4, right? That's all. We said that is the goods left in inventory. So if the subsidiary is able to pass on 1/4, then left with what? 3/4. And then to be 3/4. That's 75% of the goods are in inventory. So what do? I'll tell the examiner that unrealized profit is nothing but I'll start. Now I'll call it PUP, provision for unrealized profits. No shortcuts in exams. I tell the examiner the goods left in inventory is nothing by 3 out of 4 times what? The 40,000, because the entire goods is 40. And then they're able to pass on 1/4. So let me do what? 3/4. So 3 over 4 times 40,000. This is the goods left in inventory. Then times the profit loading. What's the profit element? 25% margin. 25% what? Margin. And you know that margin is on sales, right? And this is the sales. This is the selling price or the sales value. So times 25%. Good. So this will give us this will give us good. So 7,500. So what will be the accounting treatment or consolidated version? Good. So you ask yourself, accounting treatment, who is the seller? The seller here is what? The parent. So go to group retain earnings, go and take it from there. Then subtract it from where? The inventory figure on the financial position. You are done. If you are doing P&L, add it to what? The cost of sales in the P&L. You are done. Now, now that we know the accounting treatment, we have to learn so many ways. Yes. So I'll give you 3 different ways, and then out of these 3, you will meet one in the exam. Okay. What if yes? Is it something like cost? So markup, 25% markup, no more margin. How do you treat it? You know that markup is on cost and this is selling price. So what do? You have to gross it up. So for that one, you have to tell the examiner that if you are giving me markup, but the sales is or the value is the sales value, then what do? I have to convert this markup to margin. I have to gross up. So it's A over B plus A. So just A is the 25 and then B is 100%. That's all. You don't need to put any formula there. If it's markup, just tell the examiner that it's 20 out of 100 plus 20. Here's 25, so I'll make it 25. I'll make it 25. We are done. Good. So let's incorporate it here. So if it is markup, tell the examiner that it will be 25 out of 125%. That's all. Which we change the answer to. What do we change the answer to? So 6,000. That is it. The treatment is still the same. The treatment is still the same. So no change the treatment. Good. So we are done. So please, all right, just three examples. If you're okay with these 3 examples, when you sleep well. Good. So let's see the examples. But if you do have any question, can you let me know before we pick the examples? Great. Perfect. So now let's see. So now let's pick some few examples on how to arrive at the the unrealized profit is the one that causing the issue. So I'll write three examples. Then we look at it. Three examples. Right from here, I'll look at the PUP on the non-current assets. From there, we go to goods on transit. From there, we go to intra-group loan. Intra-group dividend will come first before intra-group loan. Then we are done with the intra-group adjustment. So that any question that we pick now, we can answer everything. Okay. I hope we saw on our first meeting how we do the consolidation for a simple financial statement. Good. So let's see. I'll write the example here. Please, I'll squeeze it. Not everything I write on the board, so some of them I'll dictate. So kindly summarize it and then be with me. I'll dictate some of them. Some of them. So examples. Critical examples. This one use red pen to write them. Example. So examples. Example one. Example one. I will use P and S representing parent and then subsidiary. I will use a bar representing sales. Example one. Parent sold goods to S for 50,000 Ghana cedis. Sorry, it's not covered. Recording a profit of 20,000 Ghana cedis. Full stop. Full stop. At the end of the reporting period, or I don't know, reporting date, subsidiary sold 30,000 of these goods for 45,000. Full stop. I am done. Example two. Example two. Example two. Parent bought materials at a cost of 60,000 and process processed it and sold to the subsidiary and sold to sub for and sold to subsidiary for for 80,000 cedis. 80,000 cedis. Full stop. One fourth one fourth of these goods are still in inventory. Of these goods are still in inventory. One fourth of these goods are still in inventory. Okay, let me add one more. Then we start. Please kindly get it and start calculating. First, calculate the PUP for me. You tell me the treatment. That's all. You calculate the PUP for me. You tell me the treatment. I'll make it 4. So 2, that's 3. Here there is subsidiary. Um, Parent has been a regular customer of the subsidiary. No, no, not write it. Yes. Hmm. I want in this question I will record the acquisition period. Acquisition date. Acquisition date in this question is acquisition period is 1st of April 20 2018, and then reporting date, balance sheet date or consolidating date, reporting date to their reporting exactly their reporting exactly 30th September 2018. I'm done. Good. Acquisition period, reporting period. Okay. Okay. So that's it. Let's continue with the remaining game. So this is a scenario. Parent has been a regular customer to the subsidiary. Parent has been a what? A regular customer to the subsidiary. That one, I'll not write it. Okay, let me put it down. Parent has been a regular customer to to the sub. Okay, to to the sub. Full stop. Subsidiary or the sub sold goods each month each month for an amount of 1,500 Ghana cedis to the parent, to P, parent, full stop. And then, but let me finish this stop. Let's continue the game here. Earning a profit of 25% markup markup full stop. At the reporting period, comma, the last 3 months sales, is still last 3 months sales are in inventory, full stop. I like the question though. But I like the question though. I like the question. I'm done. 3 is okay. I don't want to go further. It's okay. So now I want to solve it. I like the question. Good. Especially the third one. Okay, so let's see how best we can do this. So first, we are starting from the first one. It states that parents sold goods to subsidiary for 50,000 cedis, recording a profit of what? 20,000. How we get it? The profit is what? 20,000. At the end of the reporting period, subsidiary sold what? 30,000 of these goods for an amount of what? 45,000. So first, what's the treatment? This is intra-group sales. So the entire sales must be eliminated in the profit and loss statement, both from where? Sales and what? The cost of sales. That's the fair issue. That's in the profit and loss. What if there's no profit and loss? Instead is the financial position. Now let's calculate the unrealized profits. So great. Now let's see how best we can do this. I'll solve this question in 3 solid faults. 3 different ways. All of them give the same answer. Select the best one. Good. Okay, so the first style, parent sold 50,000 and a profit of 20,000. So yeah, it means that the profit is, if you are using margin, is 40%. That's margin, 40%. So first, I will use without any margin, whether margin or markup. I'll cancel it and go straight forward. Now, We are saying that to get a PUP solution, to get a PUP is the goods left in inventory. Out of the 50,000 sales, subsidiary sold what? 30,000. We sold 30,000 of these goods. 30,000 of what? Of these goods. Good. If I let me worse the case, you can even someone tell you at a cost to the subsidiary, 30,000 of these goods at a cost to what? Subsidiary. If you see that, don't let that thing confuse you. At a cost. Good. Don't let that thing confuse you. Great. So what you do is this. So it means that the goods left is what? 20,000, because out of the 50, we sold 30, so left with 20. So goods left in inventory. So open your bracket. Let examine that the unrealized profit is nothing by this 50,000 less 30,000. If you record the 20,000 is not in the question. So tell us how you arrived at 20,000. This 20,000 is not that one, it's coincidence. Good. Now times the profit loading. So times the profit what? Loading. Now the profit loading will be like this. Here you can take the entire profit of 20,000 and divide it by the entire sales. Divide by what? The entire sales of 50,000. That's all. The answer that you get, that is the unrealized profit. That's the first method. I will use different methods. Kindly select one. Do not select two. Just select one. But to be on best side, you know all these methods. Okay, so to be 20,000 times making 40,000. So 40,000 divided by 50,000. That's all. That is any answer for me. Great. So 20,000 times this. 20,000 times this. So this one gives us 2 over 5. This one you get 8,000. So this, the unrealized profit is 8,000. Unrealized profit is 8,000. That's the first method for this particular question. Please, how much or the amount that the subsidy sold it for is not needed. This 45,000 is not needed. We are not interested in how much the buyer sold the goods for. We are interested in what? The proportion of the goods left in inventory, not the one sold. We are not interested in it. Good. 8,000. So that's the first step. Then let me take it off and go to method 2. Method what? 2. Going, gone. Method 2. Method 2. I'll tell the examiner that the goods left in inventory is what? What's the profit loading on the 50,000? If when we sold 50,000, we are recording profit of what? We're recording profit of 20,000. Oh, okay. Then when we sell 20,000, what will be the profit? We don't know. Question mark. When we sell 50,000, the profit is what? 20,000. So now when we sell 20, profit will be what? That's all. I'll sell it. That's method what? 2. We're using 4 different approach or 4 different sections. Then we are done. Is it? Okay. So you do a just multiply, then you're done. Make, okay. Approach number three. That's where we use the markup or margin. Markup or margin. So approach number three, I'll use margin first. I'll first of all calculate the margin. If the entire profit is 20, margin profit is on sales, right? For margin profit is on sales. So entire profit divided by the sales. So the margin is 20,000 all divided by 50,000 times 100. So that will give us what? 40%. So that's the margin, 40%. So if I know that margin is 40%, the goods left in inventory is what? 20,000. Is the goods left in inventory 20,000 times the margin of 40%. And that will still give us what? 8,000. Can you get it? Let me do the last approach, the markup, and then I'm done. Because someone also like markup. Someone also like what? Markup. So I have to provide that section to you. Select one or select one. My interest is on the third one. Good. Okay, so let's go to the last section. If I use markup, markup. Markup is a profit on what? It's on cost. Markup profit is on cost. So what you do is, what's the profit? 20,000. What will be the cost? If we sold it for 20, that means the cost was what? 30,000. Agreed. Agreed. It means that the cost was 30,000. So the cost is 30,000 times 100. Good. That is it. And this one will give us 66.67%, right? 66 dot what? Yes, 67%. So, and to start, goods left in inventory, 20,000 times 66.67%, all divided by 166.7%. That's all. To give you the same answer. Because you got it up. Because this one is sales and markup is not on the sales. Markup is on cost. You have to convert it. You got it up. I need to give you the same answer. Exactly. So different sections. Okay, now let's move on to the second section. The second one, you are doing it for me. So try for 2 minutes, then let's solve it together. Good. The second one goes like this. You have it there. So let me take the first section off. That's where I'll solve it. Then we are done. Then we are done. So taking off the first one, I'll solve it here. So 2 minutes, please. 2 minutes. 2 minutes for us to finish right now. Great. So it goes like this. Parent bought materials at a cost of 60,000 and processed it, sold it to SAP for what? 80,000. One fourth of these goods are still in inventory. That's all. Yet you can use all the approaches that we use first. All of them. This one uh, is the same as the first one that we saw. The same. The only difference is with the first one, we said that we earn a profit of 20,000. You have a profit of 20,000. But the parent bought the item at what? 60,000. And the parent sold it for how much? 80,000. What's the profit? 20,000. So now the central focus is on this. Sales is what? 80,000. And then what's the goods left in inventory? One fourth. So one out of what? 1/4 of the 80,000 are still inventory. Then you find a profit loading on this goods. That's all. So what's the goods left in inventory first? Goods left in inventory is 1/4 times 80,000. That's all. Like this. Close it. Times the profit loading. Times the profit loading. You can use margin. Because this one is selling price. So use margin. So margin will be the profit of 20,000. So let's calculate the profit loading. That'll be 20,000 out of the 80, right? Times 100. That'll give us 25%. So either times 25% or you can tell the examiner that times 20 out of 80 to give the same answer. Good. But let me use the 25% because that's what is calculated. That is it. So, this one will give us 25%. And that will give us 5,000. So perfect. So I like that. Then look at the treatment. First, sales was 80,000. Parent sold it for 80,000. So in the profit and loss statement, 80,000 must what? 80,000 must be subtracted from what? Both sales and cost of sales. When you go to the inventory in the financial position, you take off what? 5,000 from the inventory. You are done. 60,000 is out. You don't need to touch it. So in all of the notes, I have one that you don't need to touch it. 60,000 will just help you to get a profit loading. That's how it ends back. Then, who made the sale? Is a parent who made what? The sale. The parent made the sale. So parent profit must what? Be reduced by 5,000. That's the group retained earnings must be reduced by 5,000. We are done. That's all. Okay. Now let me go to the almighty question 3. That one I'll do it. Yes, for question 3, I'll do it. Great. But if you do have questions, can you let me know before I work on the last example? Then I'll give a trial work. Please, when you or when we are done, pick the past question from 2010 or the question bank from 2010 up to today or up to last sitting. Please, all questions start calculating the PUP. That's all. Just calculate it. Both question bank and the past question. Start with the past question first. Just calculate the PUP. I am done. Now the third one is a bit somewhere, but it's okay. It's not too difficult. So now the third one says that acquisition date, 4th of what? 1st of October. Sorry, 1st of what? April 2018, right? Reporting period 30th September, right? Okay. So what is the starting point of the financial statement? What's the ending part? That means the financial statement starts at first what? 2017. And then the subsidiary was acquired when? Acquisition date. 1st April 2018. What's the reporting period? So 30th September 2018. So how many months from here to here? 6 months. So this is what we call post-acquisition period. Here is called pre-acquisition period. Perfect. Post-acquisition and what? Pre-acquisition. Post-acquisition and pre-acquisition. We are doing consolidation, so we take care of what post-acquisition. We don't care what happened past. That's all. Now, let's read this question. So, period of consolidation will be 6 months. Agreed. Parent has been a regular customer to that of the subsidiary. Subsidiary sold goods each month for an amount of 1,500 to the parent, earning a profit of 25% markup. At the end of the reporting period, the last 3 months sales are in inventory. Wow. So we said, first of all, tell me the amount of the goods that they should eliminate. They should eliminate only 6 months. So each month is 1,500, right? So times 6 months, so 9,000. So that's the total sales that must be eliminated, 9,000. So post acquisition period, 9,000. Pre acquisition, 9,000. But we are eliminating what? The post acquisition period, not the pre acquisition. Good. That is it. So sales must be come down by 9. Cost of sales must also go down by what? 9. We are done. Now let's calculate the unrealized profit. We said that unrealized profit must be what? The goods left in inventory. So what's the goods left in inventory? The goods left in inventory. Goods left in inventory. Say the last 3 months. So to be 3 months times 1,500. Agreed. That's the goods left in inventory. The last 3 months. Please, it must be the goods left in inventory must be the goods coming from the post-acquisition period. If that goods left in inventory is coming from pre-acquisition, do not eliminate any unrealized profit. If the goods left in inventory is coming from where? The pre-acquisition period, do not touch it. Leave it like that. Do not eliminate the unrealized profit. We only eliminate what post-acquisition period. So times, so this will give us the goods 3,000, 4,500, right? Perfect. Times the profit loading. Then they say markup. So what do we do? Markup. So markup will be 25% out of 125. That's all. And this will give us 25 out of 125. Good. So this is 900. We are done. So on that note, we are done with that of unrealized profit of goods left in inventory. Unrealized profit of goods left in inventory. Okay. I'm going to non-current assets. Unrealized profit on non-current assets. Then we are done with unrealized profit in general. Good. Unrealized profits. Okay, now let's move on to that of PUP on non-current assets disposed of. This time around, they are selling non-current assets, not inventory, not goods. They are selling what? Either land, building. It can be depreciable or non-depreciable. That is it. Great. Now let's move on. Okay. PUP on non-current assets. We are doing the second one. Unrealized profit on non-current assets. Yes. So I'm going to cite an example. Here. Either parent will dispose of a plant piece of equipment to that of the subsidiary at a profit. And here the bottom line is you don't need to sell to yourself and make any profit. In fact, even if you have made a profit, make sure that the profit is not within the group at the end of what? The period. Good. So let's see. Let's assume that acquisition date. Acquisition date 1st January 2018. This is acquisition. Reporting period. Reporting period 30th June. Yes, 2019. That's the reporting period. 30th June 2019. So here too is also after the acquisition. It's after acquisition. That's what we are interested in. After what? Acquisition. Okay. So after acquisition, parents sold a piece of equipment or plant. Parents sold a plant to subsidiary for 60,000 with a carrying amount of 50,000 cedis. Wow, parents, why do you do that? Full stop. That's at the date of acquisition. The sales took place at the date of acquisition. That's where the sales took place. At that date, come on. At that date, the plant had a remaining life of the plant had a remaining life of 5 years. Full stop. I'm done. That's all. Now let me explain the accounting treatment here before we look at this example. This is what example. Now accounting treatment. First of all, two things will happen. When the parents transfer the asset, the non-current asset at a profit, two things will happen. The first treatment, step one, calculate the unrealized profit. The profit. The unrealized profit. The unrealized profit is equal to how much the parent sold the item versus the carrying amount at that date. So it's equal to the proceeds or the sales value minus the carrying amount. That's the unrealized profit. How do you treat this? Unrealized profit must be eliminated from the seller's profit. Anytime there's unrealized profit, ask yourself, who made that sale? That person's profit must go down. We are done. So here, what is the accounting treatment? Number one, first treatment after calculating the profit made by the seller. Subtract from the seller's profit. So subtract this unrealized profit. This profit from where? The seller's profit. Seller's what? Profit. For example, if it is a parent, group retained earnings. If it is a subsidiary, net asset at reporting. Net asset at reporting. Net assets at reporting. Those net assets at reporting. Perfect. Net assets at reporting. Net asset at reporting. So basically, that is it. So we are saying that when there's unrealized profits on non-current assets, disposal of non-current assets, when any of them dispose non-current assets and there's a profit loading, find the profit loading. How do you find the profit loading? Just subtract the carrying amount from the sales value. That's all. So here you can see that parent sold plant to the subsidiary at the cost for a value of what? 60,000. Meanwhile, the plant cost is what? The current amount is 50,000. So the parent made a profit of what? 10,000. And this 10,000 must be eliminated from the parent profits. That's all. We are done. Treatment number two, subtract this figure, the same figure, subtract it from where? The non-current assets. The non-current, yes, subtract from the non-current assets. So the PP, in bracket the PP. So subtract it from the PP. The PPE on the group account, on the group financial position. So in the group financial position, so subtract it from the PP. So that's all. So we said that anytime there's disposal of non-current assets at a profit, okay. So that's it. Now let's go to the second treatment. Treatment number two. Now it will create, if it is a profit, it will create what we call excess depreciation. If it's a profit, it will create what we call excess depreciation. If it's a loss, it will create what we call additional depreciation. So you calculate what we call excess depreciation. Excess depreciation. It creates what you call excess depreciation if it's a profit. This is the issue. Now, parents sold it at what? 60,000, right? So the subsidiary or the buyer will depreciate it about using the 60,000 instead of what? The 50. You said that when we were doing the net assets, okay. So second treatment number two, we call it excess depreciation. Eliminate all excess depreciation. Eliminate all excess depreciation. So excess depreciation. What can I do this? What can I do this? What can I do this? Okay, I can do that. Excess depreciation. So number two is excess depreciation. Let me explain the excess depreciation. You don't need to sell to yourself and make profits first. Second, this profit should not be within the group. So there are two trouble here. If the profit has been passed on, you don't have any issue. But if it's within the group, trouble. Now the issue is this: the item that you sold, the cost is 50,000. The current amount of the plant is 50,000, and parent sold it for 60,000 Ghana cedis. So tell me, the subsidiary will depreciate it on what? 60. Meanwhile, it's a wrong figure. So it will create more depreciation. So the depreciation that the subsidiary have charged is more, is in excess. So let's go and reverse it. Now it can also happen that the parent sold it at a loss. That one will what you call additional depreciation. But that one is not common. And that one's not the usual. Good. So that is it. So excess depreciation. How do you eliminate the excess depreciation? One, A, who is the buyer? Reverse it from the buyer's profit. The buyer, not what? The seller. This one is the buyer, the one that have the non-current assets. The company that what? Have the non-current assets. So the company that have the non-current assets. So subtract it from that company's profit. Great. So now after eliminating the entire profit of 10,000, you have to calculate the excess depreciation, then you eliminate the excess depreciation. That is all. How do you eliminate the excess depreciation? First, the buyer or the one that have the assets. The one that have the assets. The one that have the assets. So that is the buyer. You can put buyer here. The buyer's profit is subtract from the buyer's profit. So the subtract is not counted. Let me put a subtraction to it. Come and go down small. Good. So let me start from here. A, subtract from the buyer's profit. Buyer's profit. B, subtract it from. Now that means they've charged depreciation. Let's hold on. But they've charged more. It's an excess, so you're reversing it, and it has been subtracted. So you have to add back. That's all. So let's add back. So add back to the buyer's profits. So just add back. Yeah. So add back to the buyer's. Yes, please. Buyer's profits.
You said they've charged excess.
Yes, so they have subtracted more from the profit. So we are adding back. We are reversing it. It's like the cash flow. The same thing, add back to that of the non-current assets on the PPE. Because the non-current assets, they have subtracted more depreciation, more value instead of. If they should have calculated it on the 50,000, they will not subtract too much. So add back to the PPE. Add it to the PPE. That's all. So that's the end of the game, and that's the end of the treatment. So I just want to seal it.
So if it's additional,
If it is a loss, with loss, it will create additional depreciation. And additional depreciation, that one is subtract. Assume that here is a loss. Here is a loss. The parents sold the non-current assets at a loss. And that one, it will create what we call additional what? Depreciation. That's all. You subtract from the buyer's profit, you subtract from the non-current assets if it is a loss. Okay, now let's solve this one, and then first of all find the profit. Parents sold it for 60 instead of the 50. So there's a profit of what? 10,000. So therefore this 10,000, how do you treat it? The seller's profit must go down by 10,000. Who's the seller? The parent. Where's the parent profit? group retained earnings. So go to group retained earnings and take off what 10,000 from there. That's the method. First side. Then second, the same 10,000. Go wherever that non-current asset is. You have to reduce that value. So non-current asset is in where the PPE. It will be among the non-current asset or the plants. The plant will be among the PPE on the financial position. So you go there and take off what 10,000 from it. So it's like here. So you subtract 10,000 from parent profit and subtract 10,000 from where the PP. We are done. Then you copy the excess depreciation. Now let me copy the excess depreciation here. Once you just take off this section. Good. So solution. First of all, unrealized profit is equal to in bracket 60,000 less 50,000 is equal to 10,000. So you know the treatment. Now let me go to the excess depreciation. Now with the excess depreciation, uh, I use a long approach and give it a shortcut. So first, calculate the what? The unrealized profits, which is equal to the profit made by the parent. He sold it for 60,000, but the current amount is 50,000. Here, this one is coming from IA 16. How do you find profit or loss on disposal? Proceed less the current amount. The same thing here. Good. So after getting it, the one who made that sale, go and subtract from that person's profit. And that person's profit, if it's a parent, that's a group retained earnings. If it's a subsidiary, it's a net asset. So here is the parent. So go and subtract from where? The parent profit. When you are done, that plant, it must be reduced from 60 to 50. So you go there and you subtract what? 10,000 from that plant figure. And then that's all. Then you come and calculate your excess depreciation. Let me do something here. Depreciation. Let's assume that the guy calculated depreciation on the 60,000. What to be the value? If we calculated it on the 50,000, what to be the value? Let's do this exercise shortly. If depreciation was calculated on 60,000, what to be the value? And that's the case because the subsidiary bought the asset, the plant at what? 60,000. Now the issue is this: the useful life of the asset is around 5 years. For this question is a bit technical because it is 1.5 cumulative years. Period of consolidation is what? For financial position, it takes cumulative years. So 1.5 years. So that's 1.5 year. 1 year, 6 months. That's the period of consolidation. Great. Now let's calculate the depreciation here. Cumulatively, from acquisition period to the reporting period, what's the total depreciation charge so far? Cumulatively. The subsidiary was acquired when? 1st January 2018. And then we are reporting when? 30th June 2019. So the whole of 2018 plus 6 months, making what? 1 year, 6 months. Agreed. Good. So 1 year, 6 months. So meanwhile, from the date of acquisition, the useful life of the plant is what? 5 years remaining. So if it is 5 years, what do? We will just pick this 60,000, divide it by 5 years, and multiply by 1.5. Agreed. And that will give us so 60,000 divided by 5. 1, 2, 3. 1, 2, 3. 60,000 divided by 5. That will give us 12,000 times 1.5. That will give us what? 18,000. Agreed. So if they should have calculated the depreciation on the 60,000, you get 18,000 depreciation on 1.5 years. Why? Because the subsidiary was acquired, acquisition date 1st January 2018, reporting period 30th June 2019. So 1 year, 6 months. So therefore, 1 year depreciation will be 60,000 divided by 5. That's 1 year depreciation times 1.5 years. And that will give us cumulatively. Please, the balance sheet takes cumulative figure and the P&L takes for the year. It's a consumption for the year. Good. Now let's see the that of the 50,000. On the 50,000, it will be so 50,000 1, 2, 3 divided by 5. So that's 10,000, right? Times 1.5. So that's 15,000. So we should have calculated the depreciation on the 15,000. So on the 50,000, they'll get what? 15,000. So that means because the asset was sold at this, the subsidiary will record depreciation of 18,000 instead of the 15,000. So the depreciation is in excess of what? 3,000, the difference. This is what they've recorded, which is wrong, but this is the right thing. That means the depreciation that they charge is more by 18,000. So what do? You reverse it by 3,000. This 3,000, how do you get the shortcut? You don't need to go through all this. 18 minus 15, you get 3. It's a long process, very long, extremely long. Excess profit, so the excess depreciation is nothing by the profit divided by the number of years times the remaining useful life, or the cumulative, divided by the remaining useful life times the cumulative years. That's the period of consolidation. You are done. Profit divided by remaining useful life times the period of consolidation. So let's see if we can get that 3, which is equal to profit of 10,000, right? Divided by 5 years times 1.5. So to give us 3,000, we are done.
So the 3,000 is what they're saying we should add back.
Yes, so 3,000 is the extra depreciation. What is the treatment? Who is the buyer? The buyer is a subsidiary in this question. Go to the subsidiary's profit and add back.
But they already charged depreciation of 18,000.
Good. He has subtracted 18,000 from his profit, which is that you subtract 15,000. So let's go and add back 3,000 to cancel the 18,000 you have subtracted in excess. So,
Minus 18.
so number one, subtract. We should go back and then subtract from the depreciation. And then here we don't have depreciation, means that we have profit. So you go and add back. So this must be reversed. So go to the subsidiary's profit, which is the net asset. What do? You add back there. So go to subsidiary's profit or the buyer's profit and add back to the buyer's profit. Then 2, go to where? The PPE in the group non-current assets and go and what? Add back, because they've subtracted 18,000 from the PPE instead of what? 15,000. So let's go and add back the 3,000. That is it. So that's the end of the game. Can we go through the steps and then you are fine? That's all. We are done with PP on non-current assets. It came in November 2016. Good. So Bantama and Abrifa. Good. Yes. Repo and Bantama. That is it. So we are done with the intra-group sales and then the grades. Please, with the non-current asset, when you go there, you add back. So in short, this question, the non-current asset will look like this. In short, so if I should provide a summary of this question, first, the non-current asset will look like this. Non-current assets. All right, PPE. Open a bracket. Parent owned plus subsidiary. That's a consolidation. Parent plus subsidiary. Now minus the unrealized profits of what? 10,000. That's the stage one. Plus the 3,000, the excess depreciation. This 3,000 you add excess depreciation. You add to it. That's all. So that's how non-current assets look like. When you go to the parent profit subtract the 10,000 from parent profit. Subtract. So this 10,000. When you go to subsidiaries profits, add this 3,000 to subsidiaries profits. So 3,000 add. That's all. So these are the treatments involved, and then we are done. Great.
So if you are doing the fair value adjustment, and
So this will be the unrealized profit and excess depreciation. That is it. So that's how the non-current asset will look like. The profit that the parent recorded must be reversed. So you take it off. And any depreciation charge extra, add back. We are done. Now let's look at the intra-group debt. Intra-group debt. Intra-group debt. That's the intra-group receivable and payable. Good. Intra-group receivable and payable. Intra-group receivable and payable. So the next section is the second adjustment. Intra-group receivable and payable. Please, as there's a thing that you can't kill yourself, the same thing you can't own yourself to. So, parents and then the subsidiary. If any of the group members owes the other, if any of the group members owes the other, they, they record it in a special book or in a special account called current account. And this must be eliminated in the consolidation process. Why? Because if parent in parent book, this is parent, maybe parent will say that receivable, in my receivable coming from the subsidiary is owing parent an amount of 30,000. Good. In the subsidiaries book, sub, in the subsidiaries book also shows that payable, I am owing my parents. So in brackets parents, owing to parents. Please, we are interested in debt or owings between parent and subsidiary. That's all. We're not interested in owings between parent and the third parties. No. Or the subsidiary third party. That's not what we are talking about. What we are talking about here is intra between group members. So if you're not a member of the group, take yourself out. If you're not a member of the group, we are not going to consider you. That is it. So that's the intra-group receivable and payable. So subsidiary will also say that okay, I'm owing parent 30,000, and this must be eliminated. That's all. It must be what? Eliminated. So here, let the examiner that all intra group receivable and payable must be eliminated. How do you do the elimination? So go to your receivable. So this is how it look like. This is their individual financial statements. You are going to consolidate it. So I'll go to my consolidation. Financial position look like this. I'll go to my receivable. Third examiner. Open a bracket. Parent owned plus subsidiaries owned less what? The intra group of what? 30,000. I am done. This is how we do the elimination. Then you go to the payables. When you go to payables, under the current liabilities, payables to open a bracket, third examiner, parent payable plus the subsidiaries payable less what? 30,000. So this is what I mean by eliminate it, subtract it from both receivable figure and what payable figure. You are done. Good. This is the individual financial statement. Now, are we saying not always to be simple like this? Sometimes there'll be some issues, such as what? Now, sometimes, if you get this one, let's move on to the critical one, okay? Sometimes a parent will tell the subsidiary that subsidiary or Mr. So and so or this PLC, you owe me 30,000. Prepare and come and pay me that money. And then the subsidiary will say, no way, I don't owe you 30,000. Me, I owe you 20,000. Ah. And parents say, oh, why? And the subsidiary will tell you that, okay, uh, just before the year end, I have sent a check of 10,000 representing a part payment of the amount due. And then the parent will say, oh, sorry, I have not received the check. Even if I've received the credit, it has not entered the account. So I've not uh, received the amount. So that's why you are still owing me 30,000. So that's it. So please, all what I'm trying to say is this. If this receivable, they are not the same, what the parent is saying the subsidy is owing him is not the same as what the subsidy is saying, then the difference, one, can be due to what you call cash in transit or goods in transit. I am treating cash in transit first, then I'll treat what? Goods in transit. They have something common. They have what? Something common because the issue is that all of them are what? They are in transit. So I'll look at the two right away. Cash in transit and what? Goods in transit. Good. Please and please again, by the time I finish with all these adjustments, let them be part and part of you because any question that we pick, they're going to meet them. Is this adjustment that make console very good? Good. So that is it. So let's look at cash in transit. So this is the illustration. So in the footnote, we will tell you that the subsidiary have transferred an amount of 10,000. Good. Just that the parents have not received the funds. You are going to make a clear assumption that the receiving company have what received the money. That's all. Please, here we are not saying the parent has received the money or the subsidiary have not paid the money. We are saying that the receiving company has what? Has received the money. That's all. The receiving company have received the money. Now, here, who is the receiving company? The parent, right? Good. So now look at what I'm going to do. We look at the accounting treatment. Good. So I don't want to clean this one. I don't want to clean this one. But I'll clean it and write this small here. Then I'll look at the cash in transit accounting treatment. Cash in transit. The accounting treatment. First, an example is here. Are we seeing? Good. And this example must be part and part of it. Parent is saying that me, my receivable, you owe me 30,000. Subsidy say no, me, payable, me, I owe you what? 20,000. Why? Because there's a cash in transit of what? 10,000. I've dispatched a cash of 10,000 to you, not receive it. Maybe I sent it on what? The last 3 days, and it has not been reflected. How do you treat the cash in transit? So, first, we are going to assume that the receiving company have what? Received it. So, when the receiving company receive, what do you think will happen? Receiving company receive, what do you think will happen? First, two treatment. When receiving company receive the money, all what will happen is this. First, first, the amount that's yet to be received have to be reduced, right? Yes, because if parents, we are going to assume that parents have received the money. So if the parents receive the money, what do you think happen to the receivable? It will go down, right? Perfect. So first, workings number one, subtract it from where? The receivable. Subtract it from the receivable. Yeah, it doesn't matter who is the who whether parent is the one who dispatch the cash or the subsidy, it doesn't matter. Subtract from receivable. Two, what do you think will happen to the cash? The parent cash. It will it will go up because when the subsidiary sign that check, he will take it off from the cash. So add it. In fact, you can record this one first. Add it to what? The cash. Add it to what? The cash. That's the group cash. That's the first one. Then what do you do? Eliminate the remaining figure. Eliminate the balance. Even though there's shortcuts. Then C, eliminate the balance. Because see, look, oh, if I subtract 10,000 from this 30,000, left with what? 20,000. So I have to eliminate what? 20. So now they are balanced, right? Before I can eliminate what? The balance. So yes, so 20,000 from payable, 20,000 from receivable. Until the intra group debt balance, you cannot eliminate it. Until this receivable of 30,000 is equal to this 20,000, you cannot eliminate it. That's why we assume that he has received it. We take off 10,000 from it. Now 11 what? 20,000. So we take 20,000, take 20,000 there, and that's all. Good. Even though I'll give you shortcut to it. Then finally, eliminate what? The remaining balance. In the brackets, the intra-group receivable less the cash in transit. That's all. How do you do the elimination? From both receivable and what? Payable. That's all. We are done. So let's reflect it here. Then I'll give you the shortcut version. The shortcut version. This one is a long push. The shortcut version. Okay, so that's the cash in transit. That was the cash in transit. So let's see how best we can do this. So let me record it here. Please, if you see current account in console, it is a special account that we should record what? Intra-group what? Receivable and what? Net. Receivable and then the payable. If you see current account, good. Now, so in the console, when there's cash in transit to affect three items, receivable figure, cash, and who? Payable. This is the console payable. Okay. Open your bracket. Parent owned plus subsidies owned. Now we said first, less the cash in transit from where? The receivable. So less that cash in transit of what? 10,000. Second, add it to the cash. So cash two, parent cash plus subsidies cash plus what? The 10,000. That's the first thing you have to do. Then you say eliminate what? The difference, the balance. Because now when the receivable received the 10,000, it will reduce the amount that you owe, right? So you eliminate what? 20,000, eliminate what? 20,000. That's all. But this 20,000 must affect the payable. Payable to parent plus subsidiary minus what? 20,000. Now let me give you the shortcut. The shortcut is that eliminate the full figure from receivable and then eliminate the payables on. So minus 30 minus 20 give us what? Minus 30. So therefore you can eliminate the entire 30 from the receivable. So receivable eliminate 30, the entire receivable must go down, take it off. And then payable too must also go off. So payable go off. The difference is what? The difference is 10,000, right? Which are cash in transit. Just add it to the cash. That's all. Add it to the cash. Positive. So this is the shortcut version when there's what? Cash in transit. Please, the examiner will not cite the thin lines like this. No. It should be in statement version. So you have to deduce it like this. You have to deduce it like this. It should be in statement version. Good. I'm done with cash in transit. Let me finish it with what? Goods in transit to complete the intra-group receivable and payable. Then we are done. Okay, good. Okay, so intra-group, still on intra-group receivable and payable. We are going to what? Goods, goods in transit. Please, when you are solving the full consolidation, please bring all these issues down. Can you bring it? Good. Normally, we don't do that. We just explain them when we are solving the question. I said, no, let's explain the issue so that when you meet, anyway, you meet it. And what if you don't meet in the question? That means we won't do it, right? But you go and sit in the exam question and say, wow. So that's it. Never work. Great. So goods in transit. Goods in transit too works like this. That one works on the payable. Goods in transit works on the payable, and cash in transit work on what? Receivable. That's the secret. And then that's the link. Now, this one too look like this. Can I take this session off? Going gone. This one too, goods. So we are now with the cash in transit. That was the one. Another two. Goods in transit. Let's take example. Parent is saying that receivable, parent said that subsidiary, in fact, you are owing me 50,000. No. Subsidiary also say, no way, Mr. Parent, me, I owe you. Me, I owe you 30,000. That's all. Yeah, I don't owe you 50,000. And parents said that, oh, sorry, oh, I have dispatched some goods to you. Just that goods have not arrived. So I have included it that you have received, you are owing me. So the parents have dispatched some goods. So goods in transit amount to what? 20,000 Ghana cedis. Agreed. Good. And Safi said, no way, me, I've not received the goods. So that's why I'm owing you 30,000 until I receive the goods. Or add it to the payable. Parent is saying that no way, you are owing me 50,000 because once I've dispatched the goods, sales have taken please. I've sent you the document, so prepare the bill. Then let me have the money. Good. Now, how do you do the consolidation? Here we are going to assume that the receiving company has received the goods. We're going to assume that the receiving company has done what? Received the goods. That's all. So step one, when he received the goods, what do you think happened to the when the subsidiary received the goods? What would be the accounting treatment? Number one. So let's go to the accounting treatment. Number one. A. What do you think will happen to when subsidiary receive the goods of the data? What do you think will happen? The receivables will go up, right? But the receivable will not be affected. Though. Here will be payable. Let me put it here, payable. Okay. So payables will goes up, right? So here what do you do? Add to that of what? The payable. Payable. Increase the payable so that now it is 50. B, what happened to the goods? We add it to the goods, right? So add it to the inventory, group inventory. Add it to what? The group inventory. Group inventory. Because the inventory will go up. The, add to the payable. Why? Because when the subsidiary receives the goods, it will increase the amount that you owe the parent. Two, the goods will increase the subsidiary's inventory because the parent have subtracted it from his inventory because on the transit coming. Then C, eliminate what? Here, not the difference. Here, eliminate the total. Yeah, the total 20,000. No, eliminate the total. That's 50,000. Here, 50,000 then that. Because if you add the 20 to this, it will still give you what? 30, right? To give you 50. You add a goods in transit of 20 to this to give you 50. So now they are the same. Until it balance, you cannot eliminate it though. Until that's what? Balance. You cannot eliminate it. Good. So basically that is it. Affect cash, that's all. So let's see how best we can work on this. And here too, I'll give you shortcut. Don't worry. All of them, they are shortcuts. When you are solving two, I'll still use the shortcut. Please, you can also have head office expenses. So try that one. That's the exception to this. Head office expenses. Aside the cash in transit or the goods in transit, you can also have the head office expenses. Good. That one I'll solve it. It's in one of the past questions, so I will explain it when I solve that one. Or even if you don't solve that one, I'll try as much as possible to explain it, look for it and explain it for you. Or not to you. Okay, so here the treatment will look like this. Goods in transit. So it will be receivable. Inventory first. Let me record the inventory first. So group inventory, receivable, what again? Then the payable. So here we said that assume that the subsidiary have received what? The goods, the 20,000. When the subsidiary receive that 20,000, it will increase the payable, right? Perfect. So here, open a bracket, parent owned plus subsidiary plus what? The 20,000 because the amount that will increase. Good. What happened to the inventory? Inventory to increase, right? Open a bracket, parent owned plus subsidiaries owned plus the goods in transit of 20,000. Good. Then, when you're done, what do you do? Then, eliminate what? The total. Now, what's the total? Total is now 50,000 because this is 50. When I add a 20 to it become what? 50. So now I'm going to subtract what? 50. Then less what?
No, even.
Less it from here. So payable plus subsidiary less 50,000. Yeah, done. So less it from both receivable and payable. That's all. Now let's look at the shortcut. This is a long approach. The shortcut is this. It's the same as you taking off this 50, taking off this 50. So here, don't worry yourself. Less the payable 30,000, subtract 30 from the payable, subtract the 50, the receivable here, the entire figure subtract it. Let it go. Let me do it all here. Here, subtract the 30,000, and here subtract 50,000. So there'll be a balance of 20, right? Add it to the inventory, 20,000. That's all. Make it positive. That's all. So this is a shortcut approach, and then you are done. That's all. So that is the elimination is you eliminate it from eliminate the total from receivable and payable. Receivable and what? Payable. From receivable and payable. And that is what we've done here. We have eliminated this 50 and this 50, and that's the section. We are eliminating it from both receivable and payable figure. That's all. Both receivable and payable figure. That is the end of this. But there are a lot of them in the past questions. So please try out. You are doing 2016 up to 2018, both May and November. I need the unrealized profits and the intra group adjustments. So far, those are the ones that we are done with it. Okay. So now the intra group adjustments left are only two. Then we are done. Thank God. So when you pick a full question, you can reach us to it. The intra group adjustment left for us to do is the intra group dividend and intra group loan. Good. So that is it.